Hello and welcome to Minerva Analytics UK Proxy Season Review for 2026. Today we're going to be focusing on what Minerva's review tells us about where dissent emerged, why it mattered, and what major events occurred across the 2026 season. I'm Alex Whitebrook, independent advisor to Minerva Analytics, and I'm joined today by Thomas Bolger, as usual, the stewardship team lead at Minerva Analytics and author of the briefing. Thomas led the analysis behind this year's review, and he'll take us through the main themes. Hi, Thomas.
Hi, Alex, and yeah, looking forward to speaking about the UK season this webinar.
Brill, well, before we get into the details, what's the biggest takeaway for this year's season? Just to start with some big picture stuff.
So I'd say this was a selective season rather than say a rebellious one, but at the same time there were still a few clear cases that stood out this year. So for the analysis, we reviewed 3,740 resolutions across 186 AGMs, which covers around 53% of the selective UK 350 index. So average opposition to management at these resolutions was around 3.38%, and only 3.07% of resolutions crossed that 20% dissent threshold, which we generally take as a significant level of opposition. But at the same time, the averages are not the whole story, and the figures are more nuanced than what, say, those headline stats are saying. So where investors did oppose management, this was actually on a concentrated level. So outcomes were consequential, and particularly in several board accountability and shareholder rights cases that we'll cover in this webinar. So I think that the key takeaway is that the headline is continued support for routine management proposals alongside targeted voting pressure where accountability, process or control concerns become more acute.
Brilliant. I think that gives us a good snapshot of how the season looked overall. So, that's it encapsulates everything, but please, everyone, don't suddenly get up and leave the webinar. We do have plenty more to dig into and get into the details. So to get us started, we're going to start talking about dissent. What in the data gives you confidence that the dissent this season was selective and not just broad unrest, more generalized?
So the data is, I think, is pretty clear. So average opposition did stay relatively low, and only a small proportion of resolutions crossed that 20% threshold for high dissent. So I think the important point again is concentration. Shareholder dissent was focused on specific companies and governance issues rather than spread widely across the markets.
Interesting, but how about if we break it down by themes then? Where did investors tend to focus that opposition this season across the different themes Minerva covers?
So board accountability was a key pressure point. So director elections generated the largest number of high dissent outcomes, with 36 management-backed candidates receiving high dissent out of a total 1,591 director elections. And in many cases, investors were signaling concerns about accountability, governance processes, ownership structures, or board judgment, rather than, say, direct disagreement with company strategy. And we do have some particular examples, which we'll jump into later, again, in this webinar. So another interesting point is when it comes to average dissent across all management proposals, sustainability-related resolutions did actually come out in front with an average of 11.7%. So it does appear that sustainability resolutions, which they cover, say on climate and also a lot of shareholder proposals, has been a consistent focal point for investors voting against management in the UK markets.
Yeah, that certainly is. I remember, we cover it every year, of course, and it has pretty consistently stayed high up there as the top, if not one of the top issues that investors are concerned about in the UK. Then carrying on with the theme of dissent for now and high dissent in particular, let's turn now to some other particular high dissent votes. Why do they matter if resolutions still pass?
So yeah, that's a good question. So if we take just that once a UK company does cross its 20% opposition from shareholders, there are actually clear expectations around engagements. with shareholders to understand the reasons behind the dissent and also for boards to respond to these concerns. And that actually comes from a recommendation from the UK Corporate Governance Code. So, as I mentioned, this season investors did use their votes to purposefully home in on a few areas of contention. So we did see 48 high dissent board resolutions, 28 capital related resolutions, and also 25 remuneration resolutions receiving that high dissent figure
Right,
of more than 20%.
right. But uh, only 22 management resolutions were actually defeated in the end, right? So there is this, as you mentioned, this pattern of high dissent. It's not broad across all companies, but very targeted. How is it that we're still only seeing the 22 management resolutions actually defeated? What does that tell us exactly?
So I think it does indicate that this season's been, say, relatively constrained, but where dissent has occurred, it has been selective and also it's sometimes expressed at a high level. So there were only, yeah, as you said, 22 defeats out of thousands of resolutions, and that's just under 1% or 0.6% of management proposals. So it does not suggest a broad rejection of management resolutions this season. But what does matter more is actually the pattern behind the defeats. What type of resolutions were getting defeated and why? So more than half of the defeats actually involved capital authorities, and that's largely because special resolutions require 75% support to pass.
We've alluded to so far throughout today's webinar, board accountability has been quite a central theme of the season. We're going back to the high dissent votes and the defeats that we discussed. That has become quite a central theme, and it often is in the UK. As you said, director elections remain a very clear route for expressing concern about oversight, judgment, responsiveness on boards. So now let's discuss the first of these two cases that you just referred to, starting with I believe we've got BP lined up. So why does that case feature so prominently in the review?
So BP is a good example of climate-related concerns moving into, say, governance votes. So Albert Manifold, BP's chair at the 2026 AGM, did see elevated opposition reaching roughly 20% once abstentions are included. Although this was actually lower than the opposition to BP's chair last year in 2025, it's still well above the normal UK levels for a chair and also director elections more generally. So the key point was that the vote wasn't just about one climate proposal. It became a question of process and governance. So BP had excluded a climate resolution filed by Follow This and a coalition of institutional investors. But the issue was that the board did not provide a clear public explanation of the legal basis for the exclusion. So investor concern moved from, say, climate issues in itself to actually votes around board judgment, transparency, and credibility. And this not only resulted in that dissent on the chair, it also contributed to large opposition votes on BP's proposals to amend the articles and to revoke previously successful shareholder proposals. And both these two latter resolutions were actually defeated by shareholders.
Hmm.
So shortly actually after the AGM on 26th of May, BP actually then removed Manifold as its chair and director with immediate effect, and the board cited serious concerns over governance standards, oversight, and conduct. So that's actually a striking outcome in itself, and also sits against a wider pattern of board instability at BP, with BP having had 3 chairs and 3 CEOs coming going more in around 3 years, and also multiple strategic shifts in recent years as well. So for context, dissent against the then chair Helge Lund reached around 25% at the 2025 AGM, and that followed a strategic reset and the board's decision not to put an updated climate transition plan to a vote. So the dissents in the last 2 AGMs does both relate to, say, board conduct and what votes they actually allow to be on the ballot.
Right, exactly. So even though the subject matter at hand may be climate or sustainability or something else, it is these board accountability mechanisms and proposals regarding director elections that are still remaining a key leverage point for shareholders in the UK, I think is the the main takeaway from the BP example, which is quite an extreme example, a big board spill to see happen this season. Now, taking us to our second standout case of the season, that would be Edinburgh Worldwide Investment Trust. What does this case tell us?
So, Edinburgh Worldwide Investment Trust, this was probably the clearest case of, say, significant director voting results this season. So, at its AGM on 30th of April, this brought a long running proxy contest with Sahaba Capital Management to a head. So, over that period, the shareholder register actually did change quite dramatically. So, private wealth and retail holders generally reduced their positions, while Sahaba and a small group of supportive US funds built a stake of around 40% or a bit more than that. So, that shift in ownership really did change the vote at the AGM, and that resulted in multiple defeats at the meeting. So resolutions 4 to 8, which covered the re-election of the incumbent directors, were all defeated. Resolution 11 on share issuance also failed, and then special resolutions 12 and 13 on preemption rights disapplication and share buybacks also failed. And at the same time, Saba's own candidates, which was 3 directors, and they were all actually elected with around 63% support. So by the close of the AGM, the board was actually only made up of Saba nominees.
But what's the broader significance of this story? I mean, the Saba kind of takeover certainly it's not the first example of this that we've seen, and it won't be the last.
So it does raise these questions around the activism, shareholder influence, and also protections for minority shareholders. So
Mm.
as ownership concentration increases, voting rights may not translate into balanced influence across the shareholder base. And that's also why the briefing notes concerns raised from the Association of Investment Companies and also wider discussions say, around listing rules and also voting rules. So the issue is not necessarily activism itself. It's also whether, say, all shareholders have enough information and also opportunity to assess proposed changes when ownership becomes concentrated. And we are also seeing similar debates in other markets, say, around the use of multiple class structures, such as the recent SpaceX IPO, and, say, protections for minority shareholders and the influence of, say, large shareholders.
Yeah, the SpaceX IPO is an excellent example. We could, and perhaps we should do an entire webinar on that. Moving on then to the topic of remuneration, obviously very related. This topic of pay remains one of the most closely watched topics, as it should be every proxy season. So I wanted you to take us and take the viewers through what stood out in 2026.
So what stood out in 2026 was actually no remuneration resolution was actually defeated in this peak season period amongst the companies we examined. But that doesn't mean opposition from shareholders was absent. It was clustered around, say, a small number of outliers, usually involving, say, executive opportunity, incentive structures, or board responsiveness to previous shareholder dissents.
I mean, okay, so I guess there's not too much to discuss around the remuneration topic in particular, but there is one thing that stood out to me in the briefing, which is that there was stronger opposition to policy votes than to remuneration reports. Um, what or policy, versus reports, votes were, quite lopsided. So why is that important?
So it does show that this season, particularly investors have been more willing to challenge future frameworks than, say, historic outcomes. So
Mm.
high dissent affected 11.3% of remuneration policy votes compared with around 5.6% of remuneration report votes. And I think that is significant this year because a lot of the debates are around, say, competitiveness and executive talent, retention and recruitment. So
Mm.
a lot of some companies have been proposing material increases to executive pay opportunity, and that's when these remuneration policy votes become important because they set for the future framework and those higher pay levels.
Right. That's actually very interesting then. Why don't you walk us through a few of the examples of some of those major remuneration outliers?
So yeah, a few of these votes stood out. So one was the was plus 500, which actually recorded around 58% shareholder opposition due to it on its policy votes, marking it the highest dissent level this season. But what's significant about that was actually more than half of the ballot actually abstained rather than voted against, which is unusual in itself. Whilst at Beazley, the opposition reached around 41% on its proposal to adopt a new long-term incentive plan because this would result in the CEO award opportunity increasing from 300 to 500% of salary. While at Smith and Nephew, both policy and LTIP resolutions attracted roughly around, say, 40% opposition, again due to material increases proposed in executive opportunity, including changes to bonus and incentive arrangements, whilst Vistry generated opposition in the mid-30s, and that related to the introduction of a hybrid incentive arrangement for the CFO. And that's the other kind of like key change which we're seeing alongside material increases in pay, those adoption of alternative remuneration structures. Well, Clarkson remained a notable case this year because remuneration resolutions at the company have now actually attracted more than 20% shareholder opposition every year since 2016. So this suggests ongoing investor concerns at the company and also raises questions about the board responsiveness to these concerns. And then finally, of course, Edinburgh Worldwide Investment Trust also recorded opposition above 50% on remuneration resolutions, although those outcomes belong primarily to that wider SABA proxy contest discussed earlier.
Excellent. Well, it's certainly I was wrong in saying there's not too much to talk about. There certainly is quite a lot to cover on remuneration this season, and I think a lot of those examples point to the need for more or deeper engagement of shareholders by those companies. Certainly, a lot of remuneration issues in the headlines this season. Then now let's turn to the state of shareholder rights and governance this season, especially when it comes to capital governance. Again, the through line through most of this year's UK proxy season briefing is the way in which the governance mechanics hold so much sway over voting outcomes. And this is something you mentioned before. Could you pick that up again and talk us through it a little bit?
Sure. So this season showed that voting results are not driven by sentiment alone. So thresholds, constitutional provisions, ownership concentration, and board discretion can all shape that final outcome. So because many capital-related resolutions require a special resolution approval, meaning that it needs to have at least 75% support to pass, that actually represents a big hurdle sometimes for shareholders to overcome. So several shareholder resolutions actually failed despite attracting, say, more than 50% backing because they did not actually clear that 75% hurdle. And that dynamic becomes particularly important when ownership is concentrated because it can, if there's a large shareholder, they can have significant say on whether that 75% threshold is actually met.
This seems particularly concerning in the way that it's structured when votes are determined simply by governance structures. That's interesting. So what should investors take away from that?
So I think investors need to pay close attention to the underlying mechanics as well as the actual proposal substance. So the briefing does conclude that, say, constitutional architecture and these voting rules actually often do shape the outcomes more than just, say, investor sentiment alone. And that's also something which we've been finding in our proxy voting blogs this season, where a lot of, say, resolutions in the US in particular around, say, removal of supermajority provisions and other related resolutions have failed to pass because of special majority voting requirements.
Very good point, actually. And for all of you tuned in and watching the webinar right now, I would very much recommend that you go to the Minerva website, minerva.info, take a look at the Minerva proxy updates. We've been doing them weekly throughout the peak season, and you'll be able to identify all of the key trends from the season in there. Each of them is a brief read, so it really gives you a good overview of what's been happening. And coming back to the to the webinar itself. One particular case that I saw regarding this ownership structures and governance structures overriding vote and shareholder sentiment alone is the case of Auction Technology Group. Could you talk us through their case a little bit?
Yeah, sure, Alex. So I think this case does provide a clear, say, example how ownership, concentration, and special resolution thresholds can impact the actual resolution outcomes. So at the 2026 AGM, resolutions 15 through to 17 failed, and these concerns preemption rights disapplications and also the authority to make market purchases of shares. So the board, in response to the votes, has stated that it's committed to continued shareholder engagement and plans to provide an update within 6 months of the AGM and also provide further information in its next annual report on that engagement. And that's related to that UK Corporate Governance Code recommendation, which we mentioned earlier about that 20% dissent threshold and board response. So at the company, Fitzwater Capital actually controlled around 21% of the voting rights, so close enough on its own to block these special resolutions. So this does mean that the outcomes may have actually could have been impacted solely on, say, the decision of one or two major investors rather than, say, the broad shareholder base.
Right. Yeah, that's obviously a very important issue to pay attention to. And good that we have such a clear example of how that can impact voting. So certainly if you want to be a good steward of your investments and if you need any help in tracking these kinds of issues, then Minerva is very well positioned to help out with that. Now, getting towards the tail end of the webinar for now, we haven't quite got around to some of the hot topics I'm sure everyone would expect us to speak about. We've mentioned climate a little bit, and you've alluded to say on climate in particular, but we should probably discuss it a little more. And then there's also the issue of AI. Let's start off with climate. What happened with say on climate this season?
So say on climate votes have appeared to become much less prominent this season. So there are actually only 3 management-sponsored say on climate votes during the review period that we looked at. So this general decline in the number of say on climate votes at company AGMs does appear to reflect, say, the 3-year voting approach, the mixed investor support for say on climate, and current political fragmentation around net zero, say energy security concerns, and also ongoing scrutiny of climate commitments. And these all seem to be pulling together to have an impact on the number of votes being put forward now, resulting in a bit of a loss of momentum for the say on climate initiative.
And although there has been that slump, I think there's certainly we've talked so much in this webinar about how governance related votes become such a key point of leverage for shareholders. There certainly still is attention being paid to climate issues. Perhaps, as you say, because of the shifting tide, say on climate is not at its peak right now. But nonetheless, did investors still pay attention to these votes, the ones that were put forward?
So looking at the voting results, it appears that the investors did pay attention. So whilst none of these 3 votes did exceed that 20% significant level, average dissent on the resolutions was 15.6%. So that is well above that 3% average across all management resolutions during the season. So while support did remain comfortably above majority levels, climate transition plans still appear to be attracting greater scrutiny than other management proposals.
Right. So bottom line is climate pressure from shareholders is not disappearing.
Yes, so climate pressure, is not disappearing, but it may be also moving through other channels. So rather than, say, relying on standalone climate resolutions, like say on climate, investors may also use, say, board elections and routine governance votes to raise accountability concerns on climate issues. And at the same time, there were, say, 2 shareholder proposals voted on during the season on climate disclosures. So it's not going away, but it just may be expressed in, say, different ways.
Excellent. Yeah, exactly. And what about everyone's favorite topic right now, moving on to AI? Did we see any AI related proposals this season? I'm sure everyone in the audience is expecting us to discuss it at some point.
Yeah, so Alex, so AI based on a resolution basis, it wasn't much of a focus at AGMs with no resolutions directly on AI, but that is maybe also reflective of shareholder proposals in the UK being relatively rare when compared to, say, the US market, where shareholder proposals on AI and lots of other factors are filed on a regular basis. So it's more likely that AI as a governance issue will more appear, say, in engagement and say examination of company disclosure and practices before they actually reach the ballot. So AI covers, say, board oversight, risk management, internal controls, disclosure. So it covers there's lots of different ways which investors can approach company practice in that area. But it appears that AI in itself has yet to drive, say, UK actual voting outcomes yet.
Mm. And although it's not yet specifically being voted on or having proposals put forward regarding AI, what evidence do we have that investor expectations are changing around that topic?
So while it's not say necessarily a ballot box issue in the UK market, yeah, it is influencing say governance expectations for boards and companies. And one clear example of how investors are approaching this is the Pensions UK's voting guidelines and their update in 2026, because those guidelines now include clear expectations on AI governance and also cyber security. So we're more, as I said, at the stage where expectations are more forming and appearing through, say, engagement with companies and general stewardship practice before they appear more prominently in actual votes and voting results.
Okay. Well, that brings us almost to a close then, Tom. Thank you so much for your time. If you had to summarize the 2026 proxy season in a single message for investors, for our audience, what would it be?
So I would say that this AGM season showed a mature but targeted stewardship environment. So board accountability appeared to be the defining theme, while remuneration concerns were concentrated in specific outliers, and the governance mechanics behind votes did shape several key outcomes. While climate pressure it is remaining relevant, but it's actually now often expressed through governance votes and director elections rather than, say, standalone climate votes. So I think the main lesson is that investors are looking beyond, say, just individual proposals to but also the systems that shape corporate decision making and what other, say, routine governance votes can be used to raise concerns. So the UK market peak season 2026 was not, say, characterized by widespread rebellion. It was more characterized by, say, targeted intervention. And in several cases, those consequences were very clear, as they at that BP example which we discussed earlier.
Excellent. All right. Well, that is a useful place to end. The 2026 season showed that targeted voting pressure still matters, as you mentioned, particularly where governance, accountability, and shareholder rights concerns all come together into that perfect storm that breeds action. So, to explore the findings that we discussed today in more detail, please go ahead and download the full UK Proxy Season Review for 2026. A copy will also be sent to all attendees after today's session. If you'd like to discuss how Minerva can support your voting, governance, or stewardship work, as I mentioned before, please do contact the team at hello@minerva.info. And do also keep an eye out for our next briefing covering the patterns in global shareholder proposals this season. We'll also be doing a comparison to previous years. So thank you very much for joining us, and thank you to Tom for sharing your insights.
Thanks, Alex, and thanks everyone joining us today.
Excellent. We hope you found this session useful. Goodbye, everyone.